Everyone, and welcome back to Bruegel's annual meeting for a one-hour session on European growth and the macroeconomy at a critical juncture. It seems that every year we are at a critical juncture, so it's great to organize this annual meeting on a yearly basis. So my name is Gregory Kless. I'm a senior fellow at Bruegel, and I'll be moderating today's panel. The objective of this session is to discuss the current European macro situation and the policies that are needed to deal with what is considered, what we can consider as a challenging situation. Indeed, as you know, inflation is at a level unseen for 4 decades. It's now at 9.1% in August. According to forward-leading indicators, growth is slowing down very quickly. We also have supply bottlenecks that are still there from COVID crisis. We have, unfortunately, a war at our doors. And if this was not enough, we also have political uncertainty in some of the countries of the euro area. So basically, it seems that the Eurozone and the EU in general is hit by a perfect storm. And so basically, the questions that I would like to ask my panelists today is what will happen in the coming months? How will we survive this difficult winter? And what should policymakers do to respond to this crisis? So these are the main questions that I would like to answer today. So to answer those questions, I'm delighted to have with me 3 great speakers that will be able to reflect on these issues from different perspectives. So we'll have let's use the order that I have chosen for the introductory speeches. So first we will have Jens Eisenschmidt. Jens is the Chief Europe Economist at Morgan Stanley. And he joined Morgan Stanley early this year, you told me in February, after working at the European Central Bank for many years. Then we'll have Beatrice Weder Di Mauro, who is a professor at the Graduate Institute of Geneva and also at INSEAD in Singapore. And of course, she is also, among many other things, the president of the CEPR. And last but not least, we'll have Jan Mischke, who is a partner at the McKinsey Global Institute, which is basically McKinsey business and economic research team. He joined the Institute in 2010 to lead its work on competitiveness and growth in Europe, but he also worked on many other topics that are relevant today, like housing, infrastructure, manufacturing, both at the European and global level. So thanks again to the 3 of you for accepting our invitation. It's really great to have you here. But before I give you the floor, let me quickly explain how we will proceed. So we'll have short introductory remarks, as I said, and that will be followed by a discussion with the audience here in Brussels, but also with our online audience. And for our audience, for those who are present here in Brussels, you will use the old-fashioned way of asking questions with a mic, while our online audience will be able to use Slido to ask questions, slide.do. This is a website where you can ask questions using a keyword which is BAM growth. You can also find it on Bruegel's annual meeting webpage. And I will see your questions here on this little tablet. So without much further ado, let me give first the floor to Jens. Jens, thanks again for coming. Maybe you can start by telling us a bit what you and Morgan Stanley forecast for Europe in the next few months, and also what you think will be the policies that will be implemented to face those difficult challenges, in particular, what will the ECB do, not only next week, but also in the next few months. Thanks.
Yeah, thanks a lot for the introduction. And yeah, it's indeed a challenging environment we are in. And I think you were saying before, I mean, I read somewhere the words perfect storm. Now, Morgan Stanley has, I mean, my department has 2 big products that are really a big headache. It's a bit like, you know, everybody comes together and produces a forecast for the economy, and not Morgan Stanley being a global bank has to be a global forecast, so everybody has to sort of agree on something. So you're jointly looking for a fixed point. So these are very work-intense weeks. And the last one we did in May, and the title of that was, for the euro area, The Perfect Storm. So essentially, we are fully aligned. Now, first of all, we have to frame everything, and I think it's of course, you will be tiring in hearing this again, but we are here in a situation in which, in Europe, we have the biggest geopolitical conflict since 45, and it would be a surprise if that wouldn't sort of be noticeable somewhere also in metrics of wealth, which is typically the way we sort of look at that, how economies perform. So we have been, like many others in the market, and that's also academic observers and research institutes have been revising down our growth forecast with the start of the war. And what was very important, of course, was to sort of get a sense of scenarios. And one of the scenarios that also, again, many others have had, and is also, of course, discussed, is what happens in case energy flows are abruptly or maybe less abruptly cut off. So that this work we already did in March, and so we traveled through the year. And of course, we have now reached a point where indeed natural gas from Russia has been cut off, which we have been not necessarily predicting, but sort of expecting as one of the possibilities and having tried to get our heads around that. So the last time we did that in very formal terms was in July. That was, you may remember, there was a date, that was actually the date coinciding with the ECB meeting, 21st of July, when there was a bit of nervosity in markets, would the gas come back on or not? It came back then, but then it later on fell. And so we had some scenarios. And that scenario, we had seen the euro area, in the case of a total cutoff, falling the activity in 23. So we are actually, most of the time, whenever we are sort of talking about growth, then this is typically already talking 23, because lots of 22 has already been with us, or we have traveled through that, and a lot of the activity is actually anyway already locked in. So really the interesting part is really the forecast for 23. And we have basically back then said it will be, in that sort of abrupt cutoff case, minus 0.7. I mean, I don't want to sort of make a very sort of precise statement about that one. It's sort of negative, it's recession, and it doesn't feel good, I guess. Now, the cutoff has happened now, and since then, several things have happened. For instance, we have had more success in building storage. We have seen certain developments in energy markets that nobody really had expected, plus that triggering a relatively aggressive fiscal response, I would say, you can characterize at least at that. So while we haven't updated that scenario, we haven't sort of, for this time around, not found compelling reasons to switch the scenarios now that the gas has been cut off. So our base scenario is we see, again, negative growth of 0.2 actually for the euro area, with some heterogeneity across countries, so Germany being affected more, other countries affected much less. And we are waiting a little bit what's the outcome, for instance, of fiscal action to be discussed. For instance, at the end of this week, we have the summit of the EU energy ministers. So that's in a nutshell the take. Now we have, of course, and I have implicitly already said something about the policy response. We have, of course, here an inflation problem brewing, and that's in large part related to energy, but not only. There we see, first and foremost now, an ECB acting much more decisively than in the past. So essentially here, we think we get on Thursday 75 basis points. I had a hard time writing that call, sort of going through all the arguments, coming from that institution that typically is a very conservative one. But I think it's probably a likely decision to be taken in a race to get the policy rates, the monetary policy stance back to neutral. You can discuss very long where neutral is, but we actually see some string of rate hikes and this whole thing ending at 2% in March next year. So that's, in a nutshell, the ECB's response. The other big policy actors, of course, fiscal, we have seen already, it depends on the country again, something to the tune of around 2% of euro area GDP being made available in terms of fiscal support. More will be coming. Example is the German package we just have heard about yesterday. And we think it's going to end up this year somewhere between 3 and 4% of GDP. Again, depending on the country, and that's on average. Now, is that enough? Well, it's not enough to prevent recession. Why not? Simply because if you just simply take the changes in energy prices and think about the wealth transfer and sort of the additional cost for each of the economies. Again, it depends on the energy mix of the economy, but you end up, depending on the economy, somewhere to the tune between 7 to 12% of GDP of additional sort of spending. If you now think that 4 to 5% in a positive scenario is being made up or being replaced by fiscal, and we are not really talking here about intertemporal substitution, it's just simply focus on this year and next, then there's a gap. Of course, excess savings will provide some of that, but activity will also sort of give in to some extent. So by and large, we think the recession is unavoidable. We are heading there, and fiscal action we are seeing right now is simply providing a backstop of this not being a total meltdown.
Thanks very much for this bleak introduction. So I'll give the floor directly to Beatrice, because Beatrice, I would really love to hear your views about what policymakers should do, maybe to try actually to avoid this recession, even though Jens thinks it's unavoidable. Do you think it's unavoidable, and what do you think they should do to avoid it, or at least to alleviate the burden?
I think we should not phrase it in terms of we want to avoid the recession at all costs, because I fully agree with and I mean it's hard to disagree with the diagnosis that we are actually transferring wealth to the rest of the world, in particular to the producers of the energy that we are buying at very high prices. That's not only Russia, let me be very clear about this. So in other words, our terms of trade have worsened dramatically, and therefore that's like writing a check every single day of several millions of, if not billions of euros, and sending it abroad. So we are poorer by this pure token. And fiscal policy, whether at certainly not at the EU level, but also at the national level, will not be able to fully compensate for that. And I also agree that the ECB is now in a position where they have to raise interest rates definitely more quickly than they would have wished to. I mean, let me put it this way, and maybe even more quickly than, I mean, it is going to be hard to play catch up with cost shocks. I mean, the monetary policy is very, very badly positioned for dealing with supply shocks, which is what we are kind of trying. Well, another way of putting it, trying to prevent that they become widespread and ingrained, and the inflation expectations become unanchored. So fiscal is not going to be enough, and monetary policy will be restrictive, and we are poor, and winter is coming. Okay, so now I cannot disagree. But again, I think we should be preparing people for this, and preparing for, recession should not be something that it is absolutely realistic that we may be running into this. Now, I think we also have to start preparing in a broader sense. And listening to the panelists this morning, especially in the geopolitical one, I heard a lot of that. People are, and of course Europeans are also aware that we are in a triple crisis. We are in a climate crisis. We already knew that, but we didn't know that it's now. We are in an energy crisis, which is escalating every day, and we are in a security crisis. And again, that is felt even more, that's felt very, very acutely in the Northern European plain countries, of which this is one. So the word, the appropriate word that I use is the one by Chancellor Scholz, who actually very early on called for a Zeitenwende, a new age. He meant that, the direct implication was that the peace dividend is over, and that one needs to invest now in military and security, but in a macro sense, that's also true, I think. And it's not because of the war only, but it is clearly accelerating many of the new age features. So the old age, and I time that to be from 1992 to essentially 2021. So we've got 30 years that were characterized by great moderation, by globalization, low and decreasing inflation rates, yes, everywhere, even in, with a very few exceptions, the low-income countries, decreasing real interest rates, and the belief, very much like in John Maynard Keynes' story about the first globalization, 100 years ago, that the belief that things could only go in one direction, namely in the direction of further improvement. And now what we are seeing instead is that all of those things I have mentioned, moderation, low inflation, and globalization are deeply questioned. There are deep question marks whether they will go on. And it is it's very likely that they will not, that they will, at least to a certain extent, reverse. We will have volatility, high inflation, and fracturing of the global economy, at least into east-west kind of domains. Well, with that kind of background, and I think we are still in the phase of, the stages of grief. We are still in the stage where there is denial and sort of, going into anger. But the denial, clearly, the summer is now, we all wanted to go on a summer holiday and, not think about it. Clear denial. Anger is also around the corner, and grief acceptance should be next. But then, the thing is, what do we do? So your question there. Well, I mean, I think the main point of where we need to act quickly is the energy prices, and I'm not talking about the caps at retail level that shield households and firms. Those is where all the action is right now, and that is essentially, as long as we keep paying very, very high prices at the border, but then sort of try to, get low prices at those who are consuming or producing, somebody has to pay for the gap. There are only two possibilities. It's the private, it's the firms, or it's the public sector. Now, this is the debate that we're having right now, in a way, who is paying there. But we are not going at the root problem, which is, why are we paying such high prices? Is this really a functioning market, or is it a game that is being played? And especially talking about gas. I mean, more than oil, which is a much more competitive market where there are many more suppliers and buyers. But in the case of pipeline gas, there is, an entry point to the pipeline, and there's an exit point to the pipeline. So in theory, there is market power on both sides. But for the last months, we have pretended that market power was only on the seller side, and that within Europe, we were competing for this gas that came out at the end of the pipeline, because we did not really get organized as a single buyer. So that's in my view, the highest priority is to organize European for gas to have a single buyer. And I have to say that Italians have been asking for this longer. I mean, I got convinced of this idea by July and published it, so relatively late. But now we are in September, and it's now it's in a way more urgent, in a way also easier, because Russia has cut already unilaterally. So why not do it now? You can no longer fear that they will cut; they have done it already. That's, my point of view, the most important policy reaction that would actually make a big difference. The derivatives of that are what a lot of countries are now scrambling to put into place, and they're, price caps, subsidies, lowering taxes here or there, all of that. You can do, we probably have to do in such a situation of war, but at least do it in a smart way. So don't give the subsidies to the companies that are actually benefiting from the situation at the moment, as was temporarily the case of the German Umlage that was thought, but now is being corrected. And do give incentives to households to still save. If you want to provide, if we want to somehow say there is a minimum supply that needs to be, that households have to be able to have in order to not freeze. Then the part above, however, they have to participate in the costs, right? So there are still the incentives to save. Right now, and I'll stop here, right now there are questions about how is it possible that, already gas and energy consumption in industry is down so much, right? So it's surprisingly how much that industry has already been able to save. Well, they've had a pretty strong incentive to do so, right? But prices do work. So we want to keep the incentive effect. We want to save. We want to transition to green as fast as possible. Don't undermine that with the temporary measures, or don't undermine it too much with the temporary measures that we will have to put in place in order to get through this winter.
Thanks very much for this intro. Let me now give the floor to Jan. Jan, for the moment we have discussed mainly about like what we need to do in the next few months, even though Beatrice already started talking about a new era and what will change the macroeconomy in the next few years. Maybe, given that you have been working more on long-term structural issues, you could tell us a bit more what you think the EU needs to do also to boost this growth, not only this winter, but also after that.
Yeah, thank you. And Beatrice, I couldn't agree more. In our view, this is also, or seems like having all the elements of being at the cusp of a really new geo-economic era. Like the last 30 years, now comes a new era for the next 30 years. And certainly on the geopolitics, not only, of course, the war and the tensions and all those things, but also the challenge to the very rules-based order that the EU economic fabric is built around. For this change alone, the EU is currently not all that well set up. It needs to try to defend that rules-based order, but it also needs to open its eyes to the fact that it might not last in the same form, and find other means of securing its economic positions. On the energy markets, definitely very good approaches to solve this crisis now. At the same time, just more investment is needed. And if you look at the situation, then already since 2015, global energy capex has been declining quite precipitously. And this, despite the transition to renewable energy sources, where you usually need about $2 of capex, where you previously needed $1 in the fossil fuel era. So while investment should have accelerated, it actually went down. So beyond the Ukraine war, we actually also in a bit of an underinvestment and structural shortage situation, which will hence also last longer than this war might last. Well, who knows how long the war lasts, but it will last long and requires meaningful amounts of investment just for the net zero transition, and that is one way of solving this for Europe, at least in the long run, about 2% of GDP for the Eurozone each year, which are numbers that are starting to be macroeconomically meaningful also when we discuss, of course, inflation, demand, and those aspects. And then as we are kind of frantically trying to solve this energy crisis, and still in crisis mode rather than thinking like solving it for the next era, we are actually also in a slow motion crisis that has received far too little attention around technology. The last 30 years have essentially been built around Moore's law penetration of devices with open and global access to technology everywhere. Now the semiconductor shortage, which by the way is going to last another 2 to 3 years, is starting to open the eyes that this may be no longer be the kind of eternal future. And the scramble for strategic autonomy might, in the end, extend to a decoupling of tech stacks, to limited access to sensitive technologies. And when we look at that, in the 10 technologies that will shape the next 10 to 20 years, Europe is holding its own on only 2 of the 10. It's falling behind vis-à-vis the US, and then more and more of those also vis-à-vis China, in 8 of the 10. Just look at quantum computing. Of the 10 leading firms, 0 is in Europe, 2 in China, 8 in the US. And I don't need to mention AI or cloud computing and the like. Now, this is actually already starting to shine through in corporate performance and corporate competitiveness. When we compare large European firms to large US firms, The European firms have, over the last 5 years, already been growing 40% more slowly, and they have been investing 40% less in R&D as a share of revenue. This is not a sustainable situation, and if you combine the two, then even in strongholds like automotive, you put AI in, autonomous vehicles, 70% of tested kilometers in the world are in the US. So you kind of see all this kind of eating away at sources of European competitiveness, and we need to solve the situation before it becomes as acute as the energy situation, because Europe's dependency on energy was also known for 30 years before it became acute. So we also need to solve that energy situation, and then maybe last but not least in terms of the macro tectonics, the inflation, the reaction of the ECB, just to throw in some numbers from work we have done to establish a global balance sheet. That balance sheet of the world, all assets and liabilities, has tripled over the last 20 years. So easy money, declining interest rates have done what you would expect them to do. They have propelled asset prices to 50% above long-run historic norms. They have also, by the same amount, increased debt, both in Europe and globally. And as you now play with interest rates, just keep in mind what that means also for the viability of debt and the levels of asset prices and all the fallout that might come from there.
Thanks very much. Let's now go to the second part of the session where we give the floor to the audience. But let me just abuse my position and ask you one question each. Let me start with you, Jens, maybe on the ECB, because you mentioned that the hikes of the ECB were unavoidable in a way. And I was wondering, are they really unavoidable? Do you really see some disanchoring of expectation? Do you really see a risk of people losing their faith in the ECB? Because actually, if you look at the main indicators of expectation, they are pretty stable. They increased a bit, but they are like around the target of the ECB.
So I think there are nuances about this, and I won't bore you with these, because I think we could spend the next half an hour about what expectations are, how they are formed, how they are measured. I think we can concentrate simply on the fact that the ECB at zero is still running an accommodative monetary policy, so in relative to where whatever new estimate of neutral rates are. So basically, if you would go around the governing council with a mic asking whatever the leaning of those members is, in your opinion, are we at or above target in the medium term, which is 2% at somewhere in 24, 25. The medium term itself is sort of time varying, depending also on the shock, but it's certainly not today. I think everybody would agree. So that means zero is too low. And that's the answer to your question. Now, the question is, of course, then later on, where is neutral and how do we get there? And this is essentially the debate on Thursday. Not necessarily where, but first and foremost, how do we get there? Do we get there with a big leap and then maybe we slow down a bit later? So that's, in some sense, the theory put out by Philip Lane. I mean, it's one interpretation of that. The farther away you are from neutral, the bigger can your step be, given that you don't know where neutral is. But, I think the short answer is yes, there is a need. There's actually also a need on other policies. I mean, that's to your point. Again, it's always very helpful to see the ECB and what their policies are in terms of how they are legally framed. There's APP, so the Asset Purchase Program, which has been devised in a situation in which there was no other tool available because rates were at their effective lower bound, I mean, give or take. And there was a business case from a monetary policy perspective with a 2% inflation mandate to fend off deflation. So APP has ended because that business case is gone. So what about reinvestments? Right? I mean, there is actually no business case for reinvestment from that very narrow perspective. There may be one in terms of market functioning, there may be one in terms of phasing it out, but that's the next shoe to drop, and that speaks to your point. Balance sheet policies have been devised in an unprecedented scale. So there was an era in the past when, for instance, Bundesbank had balance sheet policies, but then there was a time when these were really forgotten, and it was really only about the interest rate. And then the financial crisis came, and central banks started with balance sheet policies. The Fed started, very innovative, and then the ECB came late to that game. They were innovative somewhere else. The problem is now that we have, and that speaks again to your point, there is this sort of lots of developed market central banks. I mean, all the developed market central banks that we tend to think about, Japan, Bank of England, Fed, ECB, they all have expanded their balance sheet. And several of them, Bank of Japan not, ECB we will see, but Fed and Bank of England for sure, are now going into reverse in the same moment when they are going to increase interest rates. So that, and the interaction between the two policies is not very good, not very well understood. So it raises the risks that some accident happens on the way. In particular now that we have the system under so much pressure and policymakers are under pressure to react, as we have seen, there seems to be a tilt away from mere projections, looking at mere projections of inflation stability towards what is today, which is not something that would be the academic consensus on how you would sort of steer monetary policy. But it may be an optimal response in a certain situation when you can no longer trust your forecast and you have to sort of rebuild credibility, and at the same time, it could well be that today's inflation is the best predictor for the future inflation. I mean, in some sense, that's what they're saying. But if that's a reaction function of you, then you have to also act more forcefully no matter what, even though the risks are that you commit a policy error.
Okay, thanks. Do you want to react, or can I ask you a question on another topic?
Well, maybe I just want to mention a chart that I would have loved to show to you, because I think it's one of the most impressive charts of. Imagine, 20 years of the euro, and you split it more or less into half, and you look at what inflation rate and its variability was for the first 10 years. Well, not quite 10 years, but until the global financial crisis. And what you would see is a very low volatility, and it's all around the 2-ish. Actually, on the average at the end, you have a 2.2. So, the ECB was actually not fully doing it. It was not below 2, so slightly above 2. But over 10 years, fine, and with very low volatility. So everybody was mostly discussing about Pillar 3 and whether monetary policy, whether the money should also enter and so on. It was a beautiful academic discussion, completely academic, because at the end of the day, what they were delivering and in the world, the way the world was there, it was absolutely top. And then you look at the last 10 years from then on, and inflation drops below 0, and then it starts going up, and it drops again below 0, and then it goes up, and overall you get, I think it's about 1. You probably know the exact number, 1 point something, on average. So in other words, not getting there, despite all of this huge QE, despite everything. So this is the world that we were looking at and analyzing until about 6 months ago. It's only, or let's say a year ago. Right? It's not so long ago. That's what the world looked like. And then you look at the inflation rate at the very end, it goes to 9. Yeah? From not getting to 2 to 9. And that's the situation that the ECB has to confront. They cannot not do anything. It's absolutely logical. So the question then is, how much can they do? How much is going to work? Can we expect it to work in the short run? I mean, certainly not if we keep piling on negative supply shocks one onto the other. Then monetary policy, you can increase interest rates as much as you want. So it is a really in the short run, a really bad place where we are right now. Now, what we do not want is to put on top of that a euro crisis and a debt crisis within the euro area. That would be, absolutely. I mean, a perfect storm, everybody's talking about perfect storm. I think it can become even more perfect. Yeah.
Yeah, that was the question we had. We were sort of sitting down and we were saying, yeah, we had this perfect storm title I told you about in May. And we were sitting down because, of course, we are planning now for November, which is our next outlook. So what is this? What's the title? Told you so? Or still raging? Or right. It's a difficult one, yeah. But it can get worse.
In the euro crisis, I used to, sometimes use the title pages of The Economist, who also had this problem that they had essentially declared this is the worst thing, and then had to go, had to increase the, and they ended up, with a black hole or something like something universal. Yeah.
I wanted to ask you another question, actually, because you mentioned fiscal policy, and you rightly highlighted the fact that we have a huge trade-off, which is basically we need to alleviate the burden, especially for vulnerable households, but at the same time, we don't want to give them the incentive to consume more. What should they do? Because you say fiscal policymakers need to prepare people. How can they do that? How can they deal with that trade-off, if it's possible?
Well, I think I outlined what, in my view, is the most sensible solution that is being implemented. For instance, in Austria, is where you have a basic allocation, a basic allocation of gas or heating at a certain price, at a low price, and the one, if you need more, then you pay the full market price, right? But again, I do not think that the market prices today are the ones that we should be paying. So I would start from that end. But so that's it's basically a co-payment model, as we also know in other places. And then you may want to be even a little bit more targeted, because if you make that basic allocation too high, then again it becomes very costly, etc. And something similar for firms. You have to on the one hand side pick the ones where it is particularly difficult, while as much as possible conserving incentives.
No, very good plan to work on both alleviating and at the same time working on the market price through a European solution, etc. Jan, if I may, I don't know if there are questions, but let me ask you just one question before I give the floor to the audience. You mentioned a lot our reliance on the US for tech, but we have realized that we are reliant on Russia for gas, we are reliant on China for medical equipment, masks, etc. So basically being reliant on the outside has really been a big problem. What's the solution for that?
Yeah, I think so first, of course, important to remember that the most resilient supply chains are not the most national ones. The most resilient ones are the most diverse ones. So kind of have more suppliers in the mix, whether that's energy or technology or whatever it is. There's, of course, also in what seems to be the coming geopolitical order and geoeconomic order, a case to raise the game on strategic autonomy, including also doing more as an EU. And that actually means we need a stronger EU. We need more EU, or for those who don't like the EU, more coalitions of the willing of those who want to do stuff. But if you just take technology again, this is increasingly a winner-take-most market where scale matters. And of all the kind of digital technologies, scale at zero marginal cost. So if you are fast and big, you have a massive competitive advantage to those who are small or late. Now, the EU is fragmented and tends to be slow. That's not kind of a healthy mix. But you can, of course, try to overcome that. If you look at, for instance, public procurement in the EU, that's 2 trillion euro per year. Imagine what you could do if you kind of pooled more of that at the European level and said, okay, common defense procurement, common procurement and medical and pharmaceutical innovation, even innovation in broader sectors like construction, or ramping up on autonomous vehicles and the like. The kind of at scale companies that now compete cross-border across the EU and scale up to actually face their competitors in the US and China that you could create is immense. And this is just one tool. You can, of course, have any number of tens and more of policies how you can try to move towards more scale, more technology investment to step up on this game.
Thanks. Yeah, now I'm really going to give the floor to the audience because I realize we don't have much time left. I don't have any question actually on Slido, so let's take real question from real people, from physical people. So the gentleman at the beginning.
Thank you. Hello, my name is David. I work for a global non-profit actually founded by McKinsey called Generation. And my question, actually, before asking it, is to thank you, Jan, for bringing technology on the table, because I was literally on the edge of my seat in the other panel when the panelists were talking about security and defense, and nobody mentioned technology. And of course, we live in a world in which not only tanks can harm countries and people, but also cybersecurity attacks. See what happened to Estonia very recently, by the way. So my question actually to you in particular, Jan, is because you've sort of alluded to an answer in your previous remark, is in a world in which technology will be the key to becoming the leaders in most fields for countries, what role do you think Europe can play, given that, as you mentioned, it's lagging behind in most innovation, most technologies, and it's competing with two countries, the US and China, which are very far ahead? Will Europe be able to ever be more than a normative power and a market power and be maybe a digital power, or we should just think of better policies to distribute to the world and stick to what we know best in the EU bubble? Thank you.
Thanks. Let me just take 2-3 questions and then you'll have the occasion to answer. So there is someone down there, I think, and 2 in front.
Thank you, Christophe Garrity from Bruegel. I'm working on competition policy and digital. So my question is to you. So I know a little bit the environment of digital economy in Europe, and the issue of scale. So basically, we try to have scale with a measure Alstom Siemens, and the Commission say no because it will basically have an issue on national market. And the same issue will arise with digital companies. If you authorize concentration to have scale, the Commission will say yes, but we may have a problem at the national level. So how do you see these issues? Thank you.
Interesting question on competition. And there was one question, yes, here, and then we might have a second one after.
Thank you, Peter. Policymakers too. One short question and the second one a bit longer. First one, is there a study of the McKinsey Institute on, because of the figures that you presented or not? I don't know. I just am very curious. Second one is, what do you think, there's not to any specific person, about the CHIPS Act? For example, if we're talking about what the European Commission or the European Union can do, there's this kind of maybe not perfect solution, but is it the road to take? So kind of industrial investments within the European Union, or maybe some different issues that could be tackled on the EU level?
Thanks very much well, let's take one more and then I give the floor to the panelists.
Thank you. I'm the Japanese mission to the EU, so from the Ministry of Finance. So in Japan, the Japanese society, they face severe the shortage of the innovation to the economic growth. So I think that is similar to the EU. So on the other hand, EU as a whole, the focus on the digitalization or the green. So the EU, the governments, they are willing to focus on the public expenditure to this field. On the other hand, he mentioned, as you mentioned, the face the shortage of the tech innovation investment. So there is not. I think that naturally the EU's the public expenditure, they move to the Chinese company, the US company. So it is I think that it's it's not the EU government that want to. So for that situation, for example, the EU's public expansion that limited to the EU companies. It is possible. How do you think?
Thanks very much for those interesting questions. Jan, given that some of the questions were addressed directly to you, do you want to start?
Yeah, plenty of interest in technology, it seems. So, look, I think it's implausible for Europe to try to compete and win in all of those 10 big technologies that matter. It's wise to choose your battles, which can be individual technologies, for instance, losing out on clean tech, which Europe is currently, unfortunately, on track on. If you look at the next generation in terms of nuclear fusion, or also some of the advanced battery technologies. It's actually not looking as good as the status quo, where Europe is still leading, is not a good idea. So that's certainly one to try and own. But also slivers of other technologies. So if you're not the world leader in AI, well, maybe you can at least have the best AI in cars to lead in autonomous vehicles. And this way you also have a little bit of a trading and bargaining chip to then get access to the technologies where you're maybe not world leading. As said, that does require scale. And of course, the Siemens-Alstom debate is a very kind of controversial one. There's trade-offs to be made here. I think there's absolutely no reason to believe that competition isn't good. Competition is the right thing. It has always been wealth enhancing almost as long as economic history. But at what level is that competition? If there is global competition, you can actually get away with having less of it within Europe. And it looks like there is often almost like a false trade-off being made between saying, yeah, we don't want to consolidate because we want to have all this national competition, and then you end up with something like the European banking sector, yeah? Lots of banks in Germany competing for the German market, each one of them probably being like a tenth of the scale of Morgan Stanley and almost having no right of existence whatsoever. So the European banking market would be so much more competitive if you had like 4 or 5 big players across Europe, and I think that is what we need to aspire to in terms of the competitive setup also in technology. And given the winner-take-most and speed advantages, and the fact that Europe tends to be slow and actually also starting from a bad place, there could even be an argument be made for temporary shielding, like nurturing a small plant next to a big tree. You need to give it some sun for a time and some extra care. But that's, of course, even more controversial and can also backfire big time. I think those were the, oh yeah, and of course there's lots of MGI studies on our website. We're actually launching one on technology in 2 weeks from now, on the 21st. And then, yeah, the CHIPS Act and similar kind of heavy-handed industrial policy, I don't think any economist thinks that is a preferred policy, to have heavy-handed industrial policy. If the world is the kind of world that it currently is, and those around you are deploying those policies, you might have little choice if you think this is an area where you want to play. And I think saying that you want to play in semiconductors as Europe is maybe not the worst choice. But I would almost argue then you should also play to win. Then you shouldn't kind of say there's 50 billion, and I think it's 10 or so of those are actual EU money, and everything else is magically meant to be crowded in from some private companies, while the US puts 57 billion federal money down. And then you're just doing then you're just running for second place again.
Beatrice, do you want to react?
Yeah, I just wanted to comment on this. I mean, whenever we're talking about innovation, technology, digitalization, and it's very, very easy to agree that all of this is super necessary. I think it's very useful that McKinsey regularly comes up with numbers of how much investment do you need. Now, how much did you say we need for technology in Europe?
Technology investment, we don't
Yes,
have a number.
You don't have a number, okay.
But we do have a number that could be 2 trillion impact a year if we actually compete properly on those 10 by 2040.
Oh, okay, so you only have the outcome. We'd also like to know the input. I mean, I know the McKinsey study on getting to net zero, and that number was what?
It's 3.5 trillion globally a year incremental to what is being invested
per
now.
year, right. Some 300 trillion on total, no? I mean, the point is, it's useful to have these big numbers, but if I start summing them all up, and you say, oh, we need the technology, we need the digital, and so how, right? The question is how. And then, again, you know, this is this magical thing, a little bit of public money and a lot of private money, but why isn't the private money coming for? So I do find these discussions about technology and how to have to be more concrete. We can all agree that it's super important, that it's going to determine our long-run growth rates and our ability to compete, but what do we do actually, what is the #1 priority, because we can't do everything at the same time. My suggestion would be that it has to be the greening. So let's focus on that. Let's get to net zero, and also focus on how to, not only Europe needs to get to net zero, it's the world. We have 300 gigatons of emissions left. After that, we've breached the 1.5. Yeah, so if we do more than 500, we've breached the 2 degrees. That's pretty clear. And so there isn't much left. How do we make sure that what we have left, in the time we have left, we use it to actually get to net zero? So that would be my suggestion. Let's focus on that. Let's focus the technology discussion on that. Let's focus everything on that.
Thanks very much. Jens, do you want to react or to answer one of the questions that was asked?
I think it was comprehensively answered, at least from my understanding, and probably it's fairer to let the audience ask more questions in case there are.
I realize we are already running out of time, and I know some of the speakers need to leave quickly, but maybe 1 or 2 questions that are left. I think, so there is Francesco on the first, at the beginning, at the first row, and then someone there.
Well, I would seize the opportunity of the high level of the panel to ask a very general question, starting from a very specific issue. The very specific issue is how Europe is dealing with the gas problem. Now, I think I've heard from Jens that the storage is doing better than expected. Beatrice said that we're saving a lot of gas without, so far, having reduced industrial production. So that seems to say that on this specific issue, which is probably the most difficult one, because gas, as Beatrice said, is one to the other. There is very little flexibility. We are reacting better than expected. And so my general question, starting from this very specific issue, is whether we are not underestimating the flexibility that we have, which does not make us immune from a recession today and possibly next year. But over the medium term, maybe it doesn't make the situation as bad as it is. And if I compare it with the other side of the gas pipeline, which is Russia, which does not have that flexibility, over the medium term, I think I'm always err on the side of optimism all through my long life, but that we may not be as much suffering from all this as probably Russia is.
Thanks so much for this optimistic take, Francesco. There was the gentleman there on the middle row, and then I'll give you the floor one last time because we really need to wrap up for a few words to answer the question and for your last words.
Yes, thank you. Jan Litjens from the Dutch Ministry of Economic Affairs. And I was wondering, what do you think of the temporary crisis framework of the European Union for state aid and the risks it might pose for frustrating the transition to a climate-neutral economy, the digitalization, and how it might harm market dynamics, given the high labor shortages and low bankruptcies?
So who wants to take this question and also start with the last one?
Let me first it's a sort of a deep desire to answer to Francesco if I can. Okay. I mean, it's a former colleague, actually, almost boss. I spent only very few months in market operations where you were heading, but I was sort of, Francesco was always a role model at the ECB. No, I think your question is very good, and I think it's actually to the point. If you, for instance, look at the German debate, it's a debate that I relatively know relatively well in terms of what can happen if gas is missing all of a sudden from the mix. And of course, that was a debate that was not only economics, it was about how can we possibly purchase gas from somebody doing all this bad stuff over there. I mean, and that was there was from day one huge public pressure of sort of no longer accepting delivery. And then there was an industry of papers and debates of output losses of 10% sometimes on the extreme end, some others weighing in with a little bit more. But I think all in all, the situation in March looked bleaker than it looks today. And part of that is flexibility. Part of that is that the system can adjust and should adjust. That's what I would say. And it's also in our own forecast. You know, when I was saying before Europe is doing well, I mean, relatively speaking, it will still be tough. It's still not, I mean, we are basically in a situation in which our GDP will be much more weather dependent than in previous years. It's always weather dependent. If the winter's hard, you have less construction activity and vice versa. Now it's more so. So if you get a hard winter, it will be harder to avoid rationing. And even with a milder winter, you are not sure you can avoid rationing. And rationing ultimately is the thing that makes the whole forecast exercise unpredictable. But in all this is a great chance. And that goes a bit back to the other question before. Europe is and in some sense, to the questions, what should Europe do? It's in a unique spot in terms of one of the few developed markets, Japan is the other, not having anything in terms of fossil fuels. So basically having to minor fields, but basically having to put everything, all the money on renewables. And that's anyway in line with the climate change agenda. So that's a huge chance. So that's a huge chance to become a world leader because you have a necessity here. And the necessity has been brought home earlier than elsewhere. That's, you know, seize the positive things in that bad situation and, you know, seize that chance and, you know, embrace essentially that energy transition in full with lots of investment in technology. And I would stop it here because you may also want to say something, I guess.
No, I'm happy because you started with a bleak introduction. In the end, Francesco's optimism was contagious, and you end with optimistic words.
Has always been.
Beatrice?
Just a very brief remark to Francesco's question. I think we really need to have the measure of the gap. I mean, I had some numbers, but they may not be correct anymore. But what I would really like us to have is how much do we need in a normal winter? I think it's something like 300 BMPs. How much do we have on storage in Europe? How much storage capacities? We're always talking about the percentage of filling of the storage capacities.
Well, it's around 900.
Huh?
Around 900. In your units. I mean, there are many units around,
okay,
right? So
yes,
around 3 months.
That's one of the problems. We have many units.
But, you know, around 3 months.
But it's about a third
yes.
of the... so one can also talk about a third. The storage capacity is about a third of what in a normal year we would use. And then there is the forecast of what we have already been able to supplement with LNG, etc. And then there is the question, will it flow from the right country, from where it's needed, from where it's stored right now? So if all of that happens, the gap may not be so large anymore right now. But I'd like to know the number or the estimate of the gap right now, and somebody has to do this and actually give clarity to all of us, right? That's I think, what we are missing. We are talking as if the storage filling was our target and that would get us through the winter. It's not. I'm asking for more transparency. And it's something that maybe the Commission should be doing, because every single country has their own kind of discourse here and their own situation.
Jan, you get the last word.
I may just quickly relate to also some of the points on prioritization, which I agree, of course, you always need prioritization. I would think that from our work on the technology, this is not a matter of public investment. You can always do things with public investment, but it's mostly about enabling firms to scale more quickly at a European level, and technologies to scale more quickly. And then you will find the private capital to come in. In the end, of course, you do need about a percentage point of GDP more business R&D if you compare it to the US to get to power there. Hopefully not from the public purse. Net zero might be a different story. About 1.8% of GDP is needed in Europe to get there, incremental. There are some people who say that's completely impossible. I personally would say that's 1 year of growth. Can we not invest 1 year of growth in net zero? I think we should, but not my choice.
But that's only Europe.
That's only Europe, yeah. At a global level, it's also about 2%.
There is the rest of the world that is producing more emissions than Europe.
Anyway, thanks very much. I think we really had a very stimulating and comprehensive discussion. We started with monetary and fiscal, but we touched on competition policy, industrial policy, climate policy. So it was really great to have the three of you. Thanks very much again for accepting our invitation. Thanks to the audience for the nice questions. We will be back, I think, in like 40 minutes with the next session, which will be with Laurence Boone, the newly appointed European Affairs Ministers in France, who will discuss with my colleagues Jérôme Zettelmeier and André Sapir on European sovereignty. So perfect next session. Thanks again to everyone, and see you next year for the same question maybe.
Thank you.
Thanks.